Are you starting CFA Level 1? Watch this essential guide. Exam focus questions and answers. Video number 5.
Welcome to the Chartered Financial Analyst CFA Level 1 course, and as usual I provide a short introductory slide about my qualification and experience. This is the video number 5 on the topic of corporate finance and equity. Last video we started the topic of capital budgeting in the video number 1. In the series the video was number 4. Today the video number 5 in the series and the video number 2 on the topic of capital budgeting. I would like to start with a very crucial concept in finance. We know about it, but I just want to elaborate and explain it in a basic and simple terms so that we grasp the idea behind it. That is the topic of the value or time value of money. Let me give, as usual, simple calculation, simple numbering, so that we understand what we mean by the time value of money. Let us assume that now you have $1,000 and the interest rate in the market is 10%. So you could take this 1,000 and deposit it in the bank in 10% in a 1 year time and end up after 1 year having $1,100. The 10% interest times 1,000 give $100 interest payment. Along with your original amount, you end up having $1,100. You get this money in the future after 1 year. So since you are going to get it in the future, we call it future value. If this is the future value and we are today, we can say that the 1,000 is today's value, the present value. Now at the time of doing this calculation, we normally in finance we call it year 0. So this is the present value and this is the future value. So 1,000 today will earn you 10%, that is $100. So at the end of the period you end up with 1,100. We call it future value because you get it after 1 year in the future. So if you want to see the value of this today, you have to calculate it back to 1,000 and call it a present value. Let us do again simple calculation. We will hide the $1,000 and I will just simply say to you that I'm expecting to receive cash next year. At the end of the next year, worth $1,100, and I'll ask you if I can earn 10,000, what will be its value today? So we are trying to work backward. So if I'm going to receive in future $1,100, what's its value today if the discount factor is 10%? And in future we'll say the capital cost of capital. But for now the calculation will be based on our golden rule, which I mentioned in the first video, that the value of any assets equal the future cash I'm expecting to receive divide the required rate of return, which is 10. So this divide the 10 will give the value today. But there is one catch. 1,100 divide the 10% will give the value today. This is the cash and this is the required rate of return. You will get the value today, which is the $1,000. But there is a question, what is this one? Why we add 1? We just mentioned that it is cash divide required rate of return. From where I get this 1? Let us answer this question by bringing this same formula with us to the next slide. This is a slide. This is a calculation. The future cash we are expecting to receive. We divide it by 1 plus 10% required rate of return. We get its value today, its present value today. So to explain the one, let us do again simple calculation as usual. Let us assume you have a deposit of 20,000. You deposit it in the bank, and the bank will pay you 7% interest. So you are going to earn this much, $20,000 times 7%. You are going to get $1,400 after 1 year. So adding this to what you have already in the bank of 20, you get your money at the end of the period. 20,000 you already deposit, the bank will add the interest, 1,400. You end up having 21,400 after 1 year. This is the future value, and this is the present value. Now, if you notice, I get this figure after going through step number 1, calculating the interest, and then adding the interest in step number 2. I could easily do this in one step by simply multiplying the initial amount I deposited by 1 plus 7%. I'll get the same figure, 21. This is why we put the 1. Now, if I ask you, the future value is 21,400 after 1 year. What it is value today? How to get the 20,000 present value? It is simply this, divide this, will give us the, using algebra, will give us the 20,000. 21,000 cash, divide 1.47. This is why we put 1.7. The present value is 20. So let us now move on to the topic of the criteria on which we base our decision whether to invest in certain project or not. The first and important, I used to call it the first and the foremost concept or method we use to evaluate the investment is the net present value, which have this formula. Again, this formula is similar to our earlier formula: cash flow in year 1, cash flow in year 2 until the end project period, 5 years, 10 years. Divide 1 plus required rate of return to the power of 1 year 1 to the power of 2 year 2. All we know about this, and we have explained it in the first video. It is all about cash divide required rate of return. You will get the present value. But what is N? N refers to net. Net of what? Net of initial payment. You can see the initial payment is negative. Cash flow in year 0. So in the first year, we spend money to build the project or to buy the asset. Spending that money, we call it initial outlay. Initially, I paid this amount. This is cash outflow, and this is why it has a negative sign. Thereafter, we get positive cash flow all the way. We divide by 1 plus required rate of return or cost of capital. We get the present value. We minus this from all these present value, and we get the net present value today. This is again the same golden rule. The value, present value, equal cash. All these are cash. Divide required rate of return, RR. We just added the net by subtracting what we have paid in the first year. This formula is being used on a daily basis by finance professionals to find the value of shares, to find the value of bond, or to evaluate companies for acquisition if we have a proposal to buy an existing company. How much we should buy it? What is the maximum figure that we can buy it? If you have a 5-story building or a factory or whatever, any investment opportunity, whatever it is, how much I should pay to buy it? What its fair value? Its fair value is normally the net present value of future cash flows discounted to present value. To present value using the weighted average cost of capital. We will come to this later, or at least we can say the required rate of return. There is other method of valuing investment. We will come to it later on. Another way is to look at the internal rate of return, or IRR. What is the required rate of return? R that makes the net present value equal big zero. That means you spend this money today and you get the money back after 10 years, for example, and you calculate it back to its value today, you get a big zero. That is the meaning of required rate of return. Is the discount rate, R, that makes the present value of the future cash flows equal to zero. Cash flow equal the investment outlay. So all these positive cash flow equal the negative cash outflow. I mean, all the cash in equal the cash out. The result is zero. We normally use after tax. If you go back to video number 2, I just send you a square like this saying 1 minus t. 1 minus t. T is the tax rate. If it is 25%, 1 minus 25% will give 75%. So whatever cash we get, we multiply by 75%, that is 0.075, we get value less than the nominal value of the cash. Nominal value means the cash counts I get minus the tax. This is after tax cash flows. This is very crucial. Sometimes you get a question, multiple question, whether we use the cash, we deduct tax, or we use before tax. Be careful. You need to remove the cash from, the tax payment from the cash. Another way of evaluating by the way, before we go further, what's the use of IRR? If you get an IRR of 10%, then you go back and look at the cost of capital. What I mean by cost of capital? The money you are going to get, whether from equity or from debt. How much it's going to cost you? If it is going to cost you anything more than the IRR of 10%, then don't take that project, because you are going to get negative net present value. You are going to use cost of capital higher than 10. The 10 will make it 0. If it is more than 10, then this will be less than this, and you get a negative net present value. IRR also has an advantage of, before going into calculation and going ahead with the project, you know that this project have IRR of 10%. You go out and negotiate funding. If you manage to get funding less than 10%, the IRR, then you can go ahead with the project. If the funding costs you more than 10, then you cannot go with the project. This is why in the video number 2, I did mention that companies should strive to lower the cost of capital to be less than 10% in our example. How to do that? By managing the risk, by disseminating more information to the public, to market participants, to have a very strong corporate governance. All this contribute towards having lower risk environment in which the company operates. So lower risk investor will ask for lower required rate of return. Lenders, bankers will be happy to further fund to you at a cost less than 10%. So you will be able to take this project. But if you have a very weak corporate governance, if you are not giving enough information to participants, market participants, in this way we call it information vague or information opacity. There is no enough information to help investor decide whether to invest or not. So information risk will be very high. They will ask more than 10%, and if they are asking more than 10%, then you will have a very short menu of viable investment opportunity, because whatever investment opportunity you are going to get, you have to discount it by more than 10% cost of capital. So it is very crucial for finance manager to lower the weighted average cost of capital by reducing the risk so that they can create value to the shareholder. The payback period is a number of years. It's crystal clear how much you are going to spend. $10,000. You get some money in year 1, 2, 3. How much you are going to get the $10,000 you initially paid. If the first year will get you 10,000, then the payback period is only 1 year. If you are going to get your 10,000 initial outlay in year 2, that means this cash flow plus this cash flow equal this. Then the payback period is 2 years. There is some issues with the payback period. We will have example of it in the next slide. There is some issues if you decide to rely on payback period. We should always rely on the net present value and not this one. Why? Let us see what's the problem with the payback period in the next slide, and have these projects. We have project A, B, C, D until F, and these are the years. In the year 0, all the project cost the investor $1,000, exactly the same. This is why the figures are negative. It is in the year 0. So these are initial outlay negative. In the first year, you get $1,000. Project B, 100. Project C will give you $400, and so on. Also, year 2, year 3, all these cash inflow in subsequent years. Until year 4, you get all these cash flow. If you notice, project A has only 1 year life. Here there is so many. Here there is no cash in the year 4. There is no cash in the year 4, and so on. Year 5 also have cash. This is the payback period. Let us discuss this. Here the payback period is 1. 1,000, you get it next year, 1 year. Here it is 4. That is 1, 300, 600, 1,000. The 1,000 you get it in these years, which is 4. Similarly here you get it in 2 years. 500 plus 500, you get your 1,000, and so on. I think it is very crystal clear. To see the problem with this, let us calculate the net present value. See here it is negative. Although the payback period of the project A is the shortest period. Only 1 year you get your money back instead of 4 years or 2 years or 2.5 years. So if you rely on payback period, you are going to take this project. Why the net present value is negative? Because you pay now and you delay it the next year. So future 1,000 has a value less than today's 1,000. And this is what we mean by the time value of money. So you are losing money here. Also, the payback period will deceive you to take this project. We should not rely on this. There is some issues here. Let us see them by asking this question. We need to comment on each of these. Project A, we just explain it. What is the issue with it? Although it has a shortest period. Let us see question number 2. We need to comment on project B versus C. This is B and this is C. If you see these have the same cash and they have the same payback period, 4. So the investor should be indifferent in taking B or C. It doesn't matter for him whether he take project B or project C, because both have payback period of 4 years. But if you look at the net present value, you find it's only 65 and here 140, more than double the value of project B. So if you are using net present value, definitely you are going to take project C. I will come later when I finish these questions to explain why this is the case. Let us see number 3. Number 3 says we need to comment on D versus E. This is D, has 2 years. E, D and E. D has 2 years and the payback period of 2.5. This is longer period than this. So depending on payback period, we are going to take project D. Also project D has $243. Here 500, more than double. So definitely using net present value, we are going to take this. Finally, the case number 4, we need to comment on D versus F. This is D, this is F. Both have the same payback period. As investor, you should be indifferent about taking this project or this project, basing your decision on payback period. But if you look at the net present value as usual, this is 243 and this is 7,000. Huge difference. You will be misled if you take project D and you will erode the value of the shareholder. Let us say not erode because we have still positive net present value, but you miss a lot of value here. The shareholder will miss the value. You were not able to maximize their shareholder wealth, your shareholder wealth. Why this is the case? Because one of the drawbacks of the payback period is that it ignores the cash flows after the time. For example, let us see why there is a difference between here and here. Here, if you notice, 4 years. This is a 4 years. Okay, but it ignored the 500 and the 400. What that means? Project B give you yearly small amount and it grows. The total is the same. But here, project C give you the same number, but the high number in the first year. So this 400 is more valuable than 100. And this one, they have the same value. This is why this is bigger. Also, in this case, we say B and C payback period have the problem is that they ignore the time value of money. Whether the whole amount, if you calculate this whole amount, you'll find it the same as this. This is why you get 4 years. But this pays you huge amount early. And this pays you a small amount early. That is the difference. First one, payback period, ignore value of money. Second, payback period, ignore any cash after the payback period. Let us take example D and F. D and F, 2 years. But see the huge difference because after the 2 years, it ignores what comes next. Only $500 here, $10,000, huge difference. So these are the two drawbacks of the payback period as a measure of investment valuation. To solve this problem, they use what is called discounted payback period. Let us see example. The same years, cash flow, -5, 1.5, and so on. Now we are going to calculate the cumulative cash flows, adding 5,000 plus 1.5 give 3.5, adding 1.5 give 2,000 negative, adding this get negative, and so on. So here it is crystal clear the payback period is after the 500, that is 3 years and a half, something like that, exactly 3 years and a half. Let us, instead of taking the cash flow themselves, let us take the discounted cash flow. We did a discounting to this using the golden rule. You remember, cash divide 1 plus R. We get this figure. In year 1, it is the same value because raised to the power 0. So it has the same value in the same year. Here, the 1,500 discounted, it became less. Here it became even more less because it is further 2 years, and so forth. These are the net present value. Equally, we're going to calculate the cumulative figures. 5,000 plus this, give this, plus this, give this, plus this, again give this. You see, you get your money back after the 4 years. This is negative until the end of 4 years. After the 4 years, you become positive. Here, without discounting, you get positive after the 3 years, not the 4 years. That is the issue with the payback period. With this, we come to the end of video number 5. Please do subscribe to the channel so that whenever I publish new video, you get notified, and in this way you will have the full series.